What can we learn from Charlie Munger? Hi, my name is Gary Mishers. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So I think Charlie Munger is much more under the radar than his partner Warren Buffett, and I think not as many people follow his insights, and that's a mistake because I think he is an extremely smart, insightful person that we can all learn from. So one thing that I did learn from Charlie is this idea to always invert. And he got this mental model from, I think, a mathematician. But the point is, you take, let's say it's trying to solve a problem, and you rather than solving the problem that you actually trying to solve, you invert it and saying, what's the opposite of this problem? And if you avoid doing that, then you find the solution to your problem. So an example is, let's say you're looking for, finding good investments, which, I am as a value investor. That's a frequent thing that I find myself doing. And, you might approach it by looking for good investments. The idea of inversion would be to say, what does a bad investment look like? How do I find the worst investment ever? Right. And then if you avoid finding these bad investments, then by process of elimination, you probably end up with some pretty decent investments. So let's look through what, if you were trying to do this inversion approach on looking for a good investment, therefore trying to say what's a really bad investment, so I can use this inversion approach. So a really bad investment might have the following characteristics. It might be a bad business, meaning it's a company that permanently doesn't earn its cost of capital and has no hopes of doing so. It might be run by incompetent and unscrupulous people, and it might have a very high degree of financial leverage, and its security or its stock might be trading at a very high valuation. So those are the four things that, if you get those four things right, that's pretty good chance that this is going to be a bad investment. So what does that imply for us looking for good investments? That means that if you avoid investments that have any of these four characteristics, I think you're going to do certainly better than average, or at least it's certainly a good start for companies to look for. So things you want to avoid: bad businesses, bad management teams, bad balance sheets, and high valuations. That's not to say that every single company that has in one of those characteristics is a bad investment, but I think that if you do eliminate all of those, the remaining sub-universe is going to be positively biased in your favor. I hope this was helpful to you. If you like this video, please hit like and subscribe to my YouTube channel. Thank you.